Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenevec on Bloomberg Radio.
So once again this week, a story around Blue Owl Capital is among the most read on the Bloomberg terminal, has been all day. This is as the company's shares had fallen to the lowest level since 2023, with co-founder Craig Packer blaming, quote, negative articles about private credit for the decline. Now, the latest stress point, I got to say, we talked about yesterday. If you might recall, Blue Owl Capital scrapped a planned merger of two of its private credit funds after scrutiny arose over potential losses for some investors. So the story's still a live one, and we wanted to dig a little bit deeper.
To do that, we're joined by Bloomberg News Chief Wall Street correspondent Sri Natarajan. He's here in the studio, along with Davide Shiliuzzo, Bloomberg News Chief correspondent for private capital. Both join us here in the Bloomberg Businessweek studio.
All right. Welcome. Sri, I do want to start with you. You reminded us yesterday, Blue Owl, this is a firm that has been held up as kind of a poster child when it comes to the world of private credit. Is it, again, I want to ask you, the merger coming undone or something more? Like, is it just a company-specific thing that's a problem, or might it be the canary or owl in the coal mine? Like, is it something more in terms of what's going on in the private credit world?
Look, Blue Owls are supposed to be fictional characters in the real world, and it's now up to the Blue Owl management to prove that their marks are not illusory. In a credit market where you're dealing with private loans, the investors, your investors, are reliant on what you believe those loans are worth. Unfortunately for Blue Owl, many of their investors in their publicly traded BDCs don't quite believe the book value, and that's why it's trading at a big discount to book value. If you want to blame negative articles, that does sound a touch defensive and it's not going to really help the cause. And there are a lot of Wall Street veterans who are pointing in this direction and talking about trouble. But I would like to take a step back and say, when you ask about whether this is a canary in the coal mine, we haven't seen some crazy implosion. When you're investing in 100 companies, there will be some defaults along the way. Right. The question is, can you keep it below what your peers are experiencing, and is it below your historical averages? So that tells you where you are in the credit cycle. And on those metrics, Blue Owl and the rest of their peers are seemingly doing just fine. But the mind goes back to the kerfuffle last month when Jamie Dimon got on the earnings call and gave what sounded like sage advice about the credit cycle and said, when there is a problem somewhere, you can expect a few other problems to crop up, a few other cockroaches. For some reason, a lot of players in the private credit market took it as a direct insult hurled in their direction and got worked up about it. Prominent in that was Mark Lipschultz of Blue Owl, who really took a real swing at Jamie Dimon. A month later, you kind of feel like saying, if you come at the king, better not miss.
Well, before I want to bring in Davide, but Jamie Dimon, how many times have we had conversations with you? We all wait to see what he has to say about any situation. He doesn't, or does he, just drop something to stir the pot? Does he do that?
Let me tackle this carefully. I think the fact that Jamie Dimon has been the CEO of JP Morgan, the largest bank in the United States, with a $4.6 trillion balance sheet for 20 years now, right? Like it makes you think that he's coming from a vantage point that is unparalleled, to be honest. And he's got the experience and the position and the pedigree to speak his mind, and thankfully he does. In this case, and if you look back over the years, some of the things that Jamie has said, whether it's about work from home or a myriad number of topics, can veer towards the extreme. But what he said here seemed fairly innocuous. All he said was, there's never just one cockroach. There will be other troubles that crop up. He didn't necessarily say the others will be in deep distress. Why did the private credit industry take it so personally?
So Davide Shiliuzzo, come on in here, because you cover private capital for Bloomberg News. The focus that we've had this week has certainly been on Blue Owl, not just investor reaction, but also the press that we've seen around the company. Is this something you're seeing in your world outside of Blue Owl right now too?
Yeah, and I would say one thing to Jamie Dimon's comments, like, he wasn't wrong, because we have seen more of these situations, and across the industry, By the way, we've seen them on the bank side too. So I think there is a broader issue kind of in credit markets where people are questioning like some of the underwriting standards and red flags that may have been ignored in the past. And that cuts both ways. I think what Blue Owl really put on the map is an issue that all of these firms are kind of wrestling with, which is how do you sell this asset class to retail investors? And what is the right format to do that? You can, historically, they've done permanent vehicles, like very long dated stuff that it's great for institutions. You lock up your money for 7 years and it works well for them. But if you're making a push into individual investors, you have to provide some kind of liquidity. And what is emerging with this failed merger of Blue Owl is that liquidity is an in-between between daily liquidity and 7-year liquidity. And it doesn't kind of work as intended sometimes.
Well, how big of an issue is that for private credit overall if they don't have the market that includes retail investors?
I mean, I would say it's a big
investors.
issue because a lot of funds are being set up in a similar way where they provide quarterly redemptions subject to a cap. And you can either come out at NAV, which is basically the value of the assets in the fund that the manager assigns to them, or if it's in a public structure, you come out at the price that the market assigns to it. And the market right now is believing that most BDCs are 20, 30% below their asset value.
But here's the thing. There was nothing crazy or revolutionary or wacky about Owl Rock or Blue Owl wanting to merge a private fund with a publicly listed BDC. It has been done in the past. The problem and the challenge was it was being considered, or at least it was presented to the market at a time when the amount of redemptions in that private fund were climbing. And if it climbs above a certain mark, Blue Owl might very well gate redemptions. And you never want to be in a position where you tell your investors you're not allowed to get your money back. They had been honoring all their redemption requests so far. But if you ever had to get to the position of gating redemptions, or basically saying, right now we will not allow you to pull all the money that you want to pull, that spurs panic. That results in more people wanting to run away from your vehicle. So instead, when they talk about wanting to merge it with this public vehicle, which is trading at a 20% discount to book value, which means once you're in there and then you want to get out, you have a 20% loss on day one, it starts to feel a bit icky. And that's what's really resulted in this market reaction that makes Blue Owl, or at least pushes Blue Owl into this defensive corner.
But all this makes me feel like, okay, if Blue Owl is supposed to be the poster child, like if we're talking icky or redemptions or gating those redemptions, that to me, if you're talking about the poster child for private credit, then it makes me wait, like, okay, if they're supposed to be up here and they're maybe potentially having issues, what else is out there? Because not everybody's in the same situation.
And that
in other
goes
words,
back,
they're in weaker situations.
And that goes back to the broader concern about the industry. It's not just Blue Owl. I think Blue Owl is in the spotlight because they tried to do this at what some people, many people probably now would argue was terrible timing. But it is an issue that everyone in the industry has to kind of deal with.
I guess the crazy thing is, and we've had so many guests, I feel like you go to Milk in the last couple of years. First of all, everybody, all they want to talk about is private credit. And then it feels like the last year or two, it's more like, how do we get out of these deals? And like anybody who's got investments are thinking about their investors who after 3 to 5 years want to see some kind of returns. And they've struggled to get out of these investments. And I feel like they're just trying to figure out all these ways. And I just wonder at some point, do we have some kind of problems as a result? Or no, it's just, again, the timeline of how this has to come work out.
It's also the nature of credit markets, right? It's not equity investors. Credit investors generally tend to be a little more cautious because your upside is kind of capped. Yeah. You get principal back and interest on that, nothing else. Whereas if you're a stock investor, your stock could go today from $10 to $300 and then back to $150. You still would have made a lot of money.
Right.
Your 100 cents on the dollar will be 100 cents on the dollar when it comes back, or it goes down to 50, 30, or God forbid, 0. And that's why whenever there is a concern of, is the cycle turning? Is there a credit crunch coming? And when you have a space like the private credit space where funds that have been flush with cash, you see the enormous growth in that space in the last few years.
Crazy.
When they're all competing with each other to actually win deals, to put money to work, your automatic question is, did some people cut some corners, and so therefore when the cycle turns, could it be problematic? You talk about the potential issues with Blue Owl. We don't even see a ton of Blue Owl deals where there have been very obvious issues. But and Davide is too polite to point this out. But look at some of the coverage out of BlackRock and their credit investments. You've already had a trio of investment. They had just last night we reported about how one of their private credit CLO had to waive management fees because they failed one of the critical tests on the CLO. There's a alleged fraud related to big telecom receivables. And then there was another deal that Davide wrote about just last week where the mark on that investment at one of the BlackRock funds went from 100 cents on the dollar to zero. 100 to zero in a matter of weeks.
34 days.
And as we're having this conversation, one thing I keep thinking of is this comes at a time when over the last few years, we have had a lot of people in the private credit space and in the private investment space, Davide, say, these are the assets that we think Americans should actually have in their retirements. And I'm wondering if this exposes maybe a potential flaw to that strategy, this idea of marking it to market and having the traditional retail investor understand that this type of thing can be locked up for a long period of time.
And they're just looking for a new line of demand.
New place
so that
to
is
put
absolutely
the assets.
right. Like the new line of demand has been retail and insurance because the institutional market kind of tapped out. The second point I'd make is that it's very easy to sell private credit as a great opportunity when rates were rising and capital was available, and you had all of these dynamics where you could go to your investors and say, hey, you're investing in, senior loans that are at the top of the capital structure and getting, low double-digit returns with leverage, and that's great. Right now, we have rates coming down, and there is a question about, at least investors not being prepared for some disappointment when it comes to returns, but potentially credit issues when it comes to individual companies that just can't exist in that shape. And that's when you get the markdowns that we've been writing about.
Okay, so
to be continued.
Okay.
Can I just leave you with one thought?
15 seconds.
I'll wrap it up in 15 seconds because there's been too much doomerism here. When David Solomon yesterday was asked about the concerns in the market, he said something. He quoted a friend and said, skeptics often sound smart, but optimists make a lot of money.
Nice final thought. Sri and Davide, thank you so much. We really appreciate it.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Taking a look at Walmart shares, we do see the majority of stocks lower today. Walmart is higher. Yes, Carol?
Number one gainer in the S&P 500 right now.
Add that to your list for maybe...
It's done.
Okay, it's done. All right.
Yeah.
Shares up about 6.7%. They rose as much as 7% earlier in the session. This after the company raised its full-year sales and profit outlook, a sign the company's winning over price-sensitive shoppers while absorbing rising costs. Let's bring in Abby Roach. She's senior portfolio analyst who covers consumer stocks for the Empiric LT equity team at Allspring Global Investments. That team has about $14 billion that it manages across 3 large-cap portfolios. She joins us from McLean, Virginia. Abby, we're trying to make sense of what we've heard from these companies in this most recent quarter. Rival big box chains have warned that consumers remain cautious. Home Depot, it's another company that you cover. What do these results from Walmart alleviate about consumers, or do they alleviate concerns about consumers?
Yeah, well, thank you very much for having me on today. I think Walmart was definitely a strong print, and I think Walmart has continued to operate quite well in this environment. I think in terms of the health of the consumer, they called out that they've continued to see share gains from upper income consumers. I think in terms of the middle income consumers, that has been steady. And they called out slight weakness in terms of the lower income consumer. But I think we're continuing to hear similar messaging of what we've heard, frankly, for the last year of this bifurcation of the consumer, with that upper income consumer holding up quite well. And the middle income to a lesser extent as well, but the lower income consumer continues to be challenged. But Walmart in this environment, offering both value and convenience, continues to drive customers of all income cohorts, and certainly saw that in a very strong print from them, both as it relates to the environment, but they're also executing quite well here.
Abby, how much of being so massive and the world's biggest retailer means that in a higher tariff environment, this is the company that can squeeze suppliers and companies that sell into the Walmart chain because it's so massive. And so it just puts them in a better position than so many other players.
It certainly does. I mean, they're the world's largest retailer, so they are the best positioned to be able to negotiate for themselves. I think, though, too, one of the other key parts of this story is around the different alternative revenue streams. And Walmart has a benefit here of they're growing their e-commerce business. This was the 7th consecutive quarter of 20% plus global e-commerce growth. In addition to when you look at membership, advertising, other areas of the business. So they're also able to find offsets where they need to absorb some price in different areas of the P&L in a way that they're much better positioned, certainly relative to any of their peers.
Carol, are you done with Walmart? Because I want to go to Home Depot in a minute.
I want to ask one thing.
I want to go to Home Depot.
I know. But let me just ask you, Abby, what does it mean? I mean, they're transferring their stock exchange listing to the NASDAQ from the New York Stock Exchange. Like, does it really, for the exchange, it means something, but I don't know. What do you tell an investor about this? Is there anything to tell?
It was certainly an interesting part of the announcement this morning. And I think, we like Walmart here because it's, both defensive. We think they're really well positioned short term. But I think also the announcement, they're positioning themselves for growth longer term with really the focus around the alternative revenue streams, e-commerce. Just they're really positioning themselves and setting themselves up in addition to investing for growth in the future. So I think the announcement wasn't all that surprising given that has really been the tone that we have heard from this management team over the last several years.
Wait, so being on the NASDAQ means you're a growth company? Is that kind of what it is? I mean, I know that's kind of the history, but is that the idea?
Yeah, and I think, I think that's certainly how they're positioning themselves with investors. I think in addition to being defensive, but I think longer term, they are positioning themselves, from a growth standpoint with these different areas of higher growth for them relative to selling, more consumer staples type items.
It feels so old school to me. Because the New York Stock Exchange has tried to counter the narrative that, the NASDAQ is the home for tech. Yeah. So, but anyway, it's interesting. Look, these, I think it was on Surveillance this morning, Tom and Paul talking about how the NYSE and the NASDAQ, they play off each other and they try to, it's expensive to list. Right. So then, if you can actually save money by going to another exchange, maybe do that.
Why wouldn't you do it?
Yeah. Right? Okay. So Home Depot, because you also cover Home Depot, Abby. It seems like the Home Depot story is more idiosyncratic and it's like Home Depot specific. Is it fair to say after hearing from Lowe's earlier this week?
It is. I think, with Home Depot, I think certainly they're positioning themselves. They're really focused on that pro customer and especially the complex pro. I think it continues to be a challenging environment, both for the consumer, but also from a housing standpoint of the interest rate piece of that is really a key for this story. And I think we're long-term investors, so we're focused out the next 5 years from now. And I think when we look at how Home Depot is trying to position themselves with that pro customer, when we look at the environment longer term, we think there's a lot of ways that they're trying to set themselves up for future growth over the next several years, despite a bit of a challenged environment here as a result of just housing in the macro.
Why was Home Depot so concerned and Lowe's not so much? What are the differences between their business? And I know there's the pro thing and, what's the exposure that Home Depot has that caused it to say, okay, we have to think differently about what next year is going to look like. And we didn't see that from Lowe's.
I think with Home Depot, there was more explanation both around some of the recent acquisitions that they've done, in addition to conversation around the weather, sort of the lack of a hurricane in 2024 versus this year. I think investors are really never that enthusiastic to hear conversations around, there certainly is a challenge comping the comp when there's a hurricane and when there's not. But I think that coupled with commentary around different moving parts of the SRS and GMS businesses, I think just left investors feeling a little bit sour, particularly in light of the current environment.
I'm sorry, SRS is wholesale distribution of residential and commercial building. Just remind us what that is, SRS versus HRS.
Yes, the SRS distribution acquisition that they did last year as it relates to, the roofing side of the business. And without a hurricane this year, they didn't get as much benefit from that standpoint.
No, it's just like real life stuff, right? And what you need or don't need. I should point out Home Depot traded down 6% on Tuesday when it came out with its results, and Lowe's, which reported and investors reacted yesterday, was actually up about 4%. In a nutshell, how would you describe the consumer and the retail environment? Just got about 30 seconds.
I would say it's much of the same. I wish there was a different story that I could tell you, that the consumer doesn't continue to be bifurcated, but that's really the message that we've heard from different companies, is that upper income consumers continue to hold in there quite well. But I think the lower income consumers are still okay. I think they're still challenged, but they haven't dropped off a cliff. So I think consumer companies are still, operating, still meeting the needs of the different consumers while being very cautious around the sensitive needs of the lower income consumer who's more pressured in this environment.
All right. So appreciate it. Hey, Abby, thank you so much. Abby Roach, Senior Portfolio Analyst. She covers consumer stocks for the Empiric LT Equity Team at Allspring Global Investments.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Lots of news in the chip world this week. I'm going to read. So
there's so much stuff. And
but I got to go quickly.
Because, go. We have a great guest.
The U.S. has approved the sales of tens of thousands of advanced AI semiconductors to the UAE's G42 group and regional rival Humane, that's of Saudi Arabia. It's a major boost for both Gulf nations' efforts to become formidable players in the tech. And then there's NVIDIA and what's going on with NVIDIA today. Following a rally of more than 5%, NVIDIA now down 2.3%. The chipmaker did reassure investors on AI demand. Questions lingered, though, about the stretched stock prices and hefty investments.
And that's where we want to start with Lane Bess. He is the CEO of the data security company Deep Instinct, chairman of Blaze, which is an AI semiconductor company that works on low power, high efficiency processors for edge computing. He is also former CEO of Palo Alto Networks and the former COO of Zscaler. He joins us, Tim, from Miami Beach.
Lane, good to have you on the program. You've been doing this for more than 30 years. You've built and led tech companies in the U.S. and around the world. Yes or no? Are we in a bubble?
No, I don't think we're in a bubble. I actually liken this to what we saw. You mentioned I've been at this 30 years. I've seen us from the days of the DEC mainframes and IBM mainframes moving to servers, ultimately to PCs, and then ultimately to handsets that have all the power. I think what we're seeing is an AI push that's condensing what we saw over perhaps 2 decades into a 2 to 3 to 5 year time frame. The acceleration of this adoption is what might make it look like a bubble, but the applications and the growth opportunities in various markets make me feel that we're still at the front end of something that might take pauses on occasion, but certainly not a bubble.
Well, let's start with the applications of this technology. I mean, what do you see that justifies not just these lofty valuations, but all the CapEx that these companies are spending to try to achieve?
Yeah. Well, in the first place, every one of the companies that have to invest here, they have to invest to have a piece of the action. So there's almost going to be a forced action by them to invest in the GPUs, invest in the LLM models. But if you take a look at where the market will grow over time, and that's why I'm involved, as you'd mentioned earlier, in a company called Blaze, semiconductor on the edge. Again, it is like that movement from the mainframe, the central large data center, off to the edge, where a lot of the applications and solutions are going to be provided. So I see a very large opportunity of growth in semi. There's a number of companies that we've seen, Cerberus, we've seen Grok, and of course Blaze in the market, and there's many, many more. But I also see similarly a high growth in the cybersecurity area, where agentic AI attacks, dark AI attacks are going to create growth need for cybersecurity companies as well.
And that's kind of where you come in. Tell us a little bit about Deep Instinct and the work that you guys are doing.
Sure. Well, Deep Instinct is based on an advanced AI capability called deep learning. And we've heard a lot about machine learning, but AI in the form of a deep learning framework really allows you to get into a predictive, preventative mode. And it uses large GPU processing to be able to take massive amounts of data from all over the web and the dark web and be able to actually predict a ransomware attack or a breach before it happens. And so the market has been heavily, and we know very well-known names such as CrowdStrike, the past few Palo Alto Networks, Zscaler. There's still a lot in the detection and remediation mode, which is very important. You need layers of defense. You need to know what to do when something happens. But to really get a step up on some of the AI attacks, you need a more sophisticated AI. You need to fight AI with better AI.
How do you do that, though, in a world where the incentives are so aligned for bad actors to come after you? I mean, I don't know Carol, how many texts do you get a day that are like trying to dupe you into
bad stuff? A lot.
Yeah. And I mean, even we're to the point where, with the voice generation, could, really fool those companies that are used as voice authenticators. Like, there are warnings about, if you get a call from somebody in your family, it might not actually be your family. Like, we're not headed in a great direction, I feel like.
You've called off a great list of things, and really,
it's just what keeps me up at night. Don't worry, you can charge me later.
I get them too. It's but really knowing that the biggest risk to most companies and governments is insider threat. It's phishing attacks. It's deep fakes that can really fool an individual user, and that's really what they focus on as the weakest link. So what you have to be able to do, and it's what we do at Deep Instinct, we actually track and scan at massive rates all of the bits and bytes and threads that come through. And at the end of the day, if you do get a scam, or if you do get something that's in the form of a file that you open, whether it's on a text or in an email, there's a file there. Many times it's fileless, but there's a scan that takes place that will be able to stop what we call zero-day threats. It's the first time never seen threat. That's what we specialize in at Deep Instinct.
So, who do you see as your main customers, or who are your main customers?
Yeah, large globals. If you take a look at the largest number of our customers, they're global banks, there's global manufacturing, global healthcare companies, and service providers, such as the people who carry your phone conversations, your text messages. All of these are really where we focus our attention and our sales efforts.
Do you think we can ever get to a point where we don't have to be vigilant as normal human beings, or we just always have to be on the lookout and looking over our shoulder that somebody's going to get our data, somebody's going to get access to our accounts?
Yeah, this is going to be a game that continues cat and mouse for the longest time. And it's why, quite frankly, the cybersecurity sector continues to be a strong sector. There are going to be some consolidation in that sector, as we've seen in recent months. In fact, this year, 2025, has been a significant year for consolidation. I see 2026 being the same. But everybody, the largest platform players, including Palo Alto, Zscaler, are accumulating the capabilities to be able to do everything from access identity management to make their SOC or their security operations centers more efficient. The consumer will continue to be under attack. And really, my best advice to consumers is, if it doesn't look like anything you know or anybody you've heard from, don't click on it. When it comes to businesses, put the best layers of defense in place, including AI capabilities that are going to be able to battle more sophisticated attacks.
So you're basically saying you are for anybody who's creating data before it starts to go anywhere in the AI world, or use, if you will, of through the AI lens. That's where you guys enter.
That's correct.
It's like cleaning out the data, making sure it's pure, it's clean.
You hit it right on the head. That's really only what bad actors are going after: data. It might be your individual data, but more regularly, it's compromising corporate data, government data. That's where they have the most leverage and can hold for ransom. They can disrupt operational capabilities. And at the core of this, being able to scan every byte of data, whether it's on-premise or in the cloud. These days, most companies are adopting multi-cloud strategies: AWS, Azure, Google GCP. Your data is everywhere. And if you cannot protect your data, then you're going to be at risk. And in many cases, a lot of corporations have data that's already corrupted and they don't know it. So what we really promote is not only being able to scan inline the data in the files, leveraging Deep Instinct or other AI technologies, but also being able to scan all of the data you've had resident in large data centers that you've been storing data for years in some cases. In many cases, data that has been disturbed has been corrupted for more than 86 days before somebody determines that there is actually something bad there. And that's just an impossible number of days and too long of a time.
Do we need a new way to authenticate ourselves? If the data that we traditionally use, like social security numbers or parents' maiden names, those things are out there, what's the right way to prove to an entity that we are who we say we are?
Well, I think the efforts in multi-factor authentication have been very good.
Okay.
While it might seem aggravating sometimes every time you want to log on to a bank account or into some piece of or data website that you're looking to access, that you have to get a code text to you or sent to your email, these two multi-factor authentication methods are really helpful. And at the end of the day, they do help identify that you are who you are. Identity access management is another key growth area in the cybersecurity space as well. And AI tools are being applied there as well to help.
Just one last, I'm going to go back to where we started because it's just top of mind, the narrative about the questions behind the AI trade, the AI spend, the circular financing, the valuations. You're not worried. Just got about 30, 40 seconds here.
No, not really. I think we'll see pauses. I don't see a trade-off on NVIDIA today. Believe me, I've been involved in many great earnings calls where after the earnings call is done, the stock drops and you scratch your head. I don't think that's an indication as to any chink in the NVIDIA armor here. I think we'll see some pauses and resuming. But as I do say, I think the shift towards the edge and companies plays are going to be where we're going to see additional future growth. And that will come alongside with growth from NVIDIA as well.
Well, so glad we could go there with you. Certainly another window into this AI build out. Lane Best, he's CEO of the data security company Deep Instinct, chairman of Blaze, former CEO of Palo Alto Networks, former CEO of Zscaler.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Okay, let's bring in Brent Schutte. He's CIO at Northwestern Mutual Management. They've got more than $300 billion in assets under management. Brent, good to have you on the program. A lot has changed since you were last on with us in the middle of September. We had an entire government shutdown, the longest ever in history. We had the government reopen, so we've gotten some late data. We've also had some cracks start to form around what many consider being the AI trade and questions about CapEx. How are you looking at all this?
There certainly are quite a few cracks, and I know that the commentary about NVIDIA's earnings, I think the reality is there's still questions about the sustainability of AI and what it becomes in the future. There are economic questions, so think about the unemployment report, the jobs report. Where is the labor market at, coupled with inflation, and what does the Fed do about that? And then I just think there's lots of market questions. So you've seen a large run-up in non-profitable tech companies. You've seen cryptocurrencies start to fall quite a bit. You've seen private credit cracks start to emerge. And that's where I think there's lots of questions that are still unanswered. I think investors are finally starting to pay attention to those. Yeah. That's where I would just counsel people to please stay diversified. I know the temptation has been to concentrate in these AI names, in these tech names that have been the high flyers that have carried the markets for much of the past few years. I just think in the future, the answer is going to be a broadening out across the spectrum of asset classes, large cap overall, small caps and mid caps, which actually trade at pretty cheap levels relative to their large cap counterparts. And yes, even international stocks. I guess the question is, do we have a hiccup before then?
Well, I want to talk a little bit more about diversification. Before I do so, if I look at the Bloomberg Mag 7 index, it is still up nearly 17% year to date. If I look at the S&P 500, it's only up about 11%. We can go on. But so I think this, Brent, people will counter and say, well, wait a minute, though. I get it. This is where everybody runs into, but they tend to continue in many cases to outperform.
They continue until they don't. At least historically, that's been the case. And leadership has always changed. And towards the end of economic cycles, or think about it, after the Fed tightens rates, you harm the economy because they're trying to slow the economy to slow inflation. But that doesn't harm it all at once. It harms manufacturing. It harms housing. It harms smaller cap companies until at least historically you get enough critical parts of the economy that have been harmed to where you actually have a recession, and then we broaden back out. That has happened in every single cycle. It's not odd for the market to become concentrated. Then typically on the opposite side, what ends up happening is that the economy broadens back out, and those things that have been harmed become better again or healthy again as rates are usually lowered. And that's where no matter what happens in the next few months, I do think you have to have a market that broadens. You have to have an economy that broadens. You can't have the housing market continue to not operate. And that's where I think there's opportunities pushing forward. And it's kind of the same formula that occurred post 1999, where you did see the internet, which is where everybody concentrated back then. It benefited more than just the companies that were putting it in place. It benefited the economy and the broader set of the economy and companies. And that's where I think you'll see AI have the same impact pushing forward.
Brent Schutte, you were going through a litany earlier of sort of cracks that are starting to appear. You mentioned private credit. Carol and I are certainly trying to get to the bottom of everything happening in private credit right now. It's a thing we're going to continue to focus on it.
Totally.
Yeah. I mean, it's really piqued our interest. The crypto part that you mentioned with Bitcoin sliding, right now, Bitcoin down another $4,000 today, 86,400, lowest going back to April of this year. Does that send, what is the signal that sends? Like, why are you even mentioning it?
Liquidity and speculation. And so that's where I think, whether or not and what it is or what it is not, we can debate that all we want. But it certainly, to me, still is a speculative part of the market. There are other cryptos besides Bitcoin, some that have no purpose and no stated purpose, and they have a lot of money in them. To me, that's been a sign of speculation and a lot of liquidity that's still floating around in the economy, in the markets. And that's where I'm wondering what is happening underneath the surface with liquidity. Are people being forced to liquidate? Where is there leverage in the economy? This is where I think there's quite a bit of leverage. And that's where I think you look at this part of the market and you wonder what it is signaling. And that's where I think it's just nice to pay attention to the risks that are potentially out there. And this certainly is one of those.
Yeah, I keep thinking about that, Brent, too. Like, I just, for those of us who've been around through some market cycles and crises, I think of the great financial crisis where everybody was like, go, 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 until it all came undone. And then when it came undone, it was pretty harsh. I don't want to be an alarmist. I just want to be smart here. And I think, as you continue to look at this market, I mean, are you anticipating a certain amount of correction? And is it because of concerns of private credit? Is it because of AI? Is it both? Something else? Help me out here.
I think it's all the above. I think there are lots of things that are concerning out there. This doesn't mean that you run out and you sell all your stocks or do anything drastic. It just means that you pay attention to what your risk level should be based upon a financial plan and that longer term asset allocation that you have chosen in that plan, which in that plan, there is the reality that stocks go up and stocks go down and that we actually have pullbacks in the economy. And that's where I just fear that people are doing what they shouldn't be doing, which is concentrating. If you didn't concentrate in the market in the late 1990s, in the NASDAQ, in the tech sector, you didn't have the large drawdown that the people who did. And that's where I'd counsel people to think about that and think about what has worked as a timeless investment philosophy, which is diversification. And that's where if you diversified post 1999, which I get a lot of questions about, what are you doing to keep me from having the if it's a bubble, what are you doing to keep me from falling prey to that? Which the answer is just diversification. That was the answer then. It's the answer today. I know it's not popular. It's not cool. It's not as sexy as watching the rips in stocks, but it is the best answer that anyone in my position has come up with in 40, 50, 60, 70 years of doing this. And that's where I would encourage people to avoid the urge to concentrate, which I know is out there. I also know the urge of greed in making, if your account should be 60% equities and it's moved to 70% equities, you might not be apt to rebalance, which you should rebalance back to 60% equities. And that's where I just encourage people to do the time-tested investment strategies that have worked There are certainly tilts you can make, things that you can do, but that time-tested strategy is how people have at least historically gotten from point A to point B, and I think that's will be the same way in the future.
It sounds like a lot of what Brett's speaking about is comes down to behavioral finance, and it's like controlling our emotions, which is such a big part of what we hear from advisors increasingly now, which is like, hey, you have your goals. Make sure you stick to them, no matter how enticing something is.
Listen, take the emotion out, right? It's what prevents you from chasing trades or getting out completely when things start to come undone. Brent, perfect chat on this Thursday. We really appreciate it. Brent Schutte, CIO, Chief Investment Officer over at Northwestern Mutual Management.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.